Welcome to today's deep dive, August 6, 2026. Today, copper, which is just this basic, totally unglamorous metal, hit its highest price in human history.
Yeah, which is a massive milestone.
It really is. I mean, it powers everything from your toaster to the global electrical grid. And ironically, that massive price spike in old-school manufacturing might be the single biggest threat to the digital AI revolution we're living through right now.
It's a huge paradox, yeah.
Right. So we're looking at a stack of daily market briefing notes today, and our goal for you listening is to cut through all the noise of daily market fluctuations and really extract the mechanics of what is actually moving the global economy.
Exactly, because there is a lot of noise out there right now.
So much noise. But before we get into that whole paradox of copper and AI, we really have to look at the massive anchor hovering over the broader U.S. stock market today. Looking at this data, the market is just incredibly volatile.
Oh, absolutely.
It seems like every trader on Wall Street is holding their breath for Friday's upcoming July jobs numbers.
Yeah, that anticipation is really driving the baseline for the entire week.
Right.
The expectation that's mapped out in the briefing is a gain of 83,000 non-farm payrolls.
Okay.
And they're expecting the unemployment rate to hold totally steady at 4.2%.
Okay, let's unpack this right out of the gate. Because we hear the term non-farm payrolls thrown around on financial news like constantly.
Right, it's everywhere.
Yeah. But just to clarify for anyone who doesn't spend their day staring at a Bloomberg terminal, why do we specifically exclude farming from this holy grail of economic data? I mean, does agriculture just not count?
Well, it counts, obviously, but it totally distorts the picture.
How so?
Agricultural employment is just heavily seasonal. You hire these massive crews for planting in the spring and harvesting in the fall, and then you just lay them off.
Oh, right. So the numbers would spike and crash all year.
Exactly.
Yeah.
If you include farm workers in the monthly data, the employment graph looks like a heart monitor. It makes it nearly impossible to spot genuine underlying economic trends.
I see.
So by stripping out the farm data, the Federal Reserve and the markets can actually see the true structural health of the labor force.
That makes perfect sense. So looking at this non-farm expectation of 83,000 new jobs and that 4.2% unemployment rate, wait, let me rephrase. Is this the anchor the market is desperately looking for amidst all this volatility, or is this just a brief pause before things get worse?
It acts as a macroeconomic floor, really.
Okay.
When we see a number like 83,000, we're looking at a labor market that is stabilizing. It's not running incredibly hot.
Which would be bad, right? Because then employers desperate for workers and jacking up wages.
Exactly, which eventually sparks inflation. But it's also not collapsing into negative territory either.
Right. It's kind of a Goldilocks number.
Yeah. If people are steadily employed, they're steadily spending. And if they're spending, the broader macroeconomic engine just keeps turning.
Got it.
But here is where the data gets complicated. The macro picture, those 83,000 jobs, is stable. But beneath that surface, the micro picture is incredibly fractured.
Fractured is honestly an understatement. Looking at today's gainers and losers, it feels like these companies aren't even operating in the same economy.
Well, they are operating in the same economy, but their unit economics are being radically redefined by one specific catalyst right now.
Artificial intelligence.
Exactly. We are finally moving past that era where a CEO could just say AI on an earnings call to get a quick stock bump.
Oh, yeah, the hype cycle.
Right. We are now in the actual deployment phase. AI is becoming a measurable driver of engineering productivity, and that drastically alters a company's profit margins.
The sources have a perfect and honestly kind of surprising example of this today.
Oh, Greener. Right.
Yes. Greener is highlighted as one of the top gainers in the entire market today. They just reported extremely strong earnings, and they specifically cited that their AI spend boosted their engineering productivity.
Which is fascinating to see in an earnings report.
Right. And they said that efficiency translated directly into stronger subscriber growth.
But wait, if you're an app developer, how does an AI debugging tool actually lead to more subscribers?
Well, it changes the fundamental math of a software business.
Okay, walk me through that.
Historically, if an app like Grindr wanted to roll out, say, 3 major new features to attract paid subscribers, they had to hire an army of new developers.
Because software engineers are expensive.
Very expensive. And onboarding them takes months. It was a massive capital expense with a really long delay before you saw any return.
Right, you're paying salaries long before the feature even launches.
Exactly. But today, by leveraging AI for code generation, automated debugging, back-end optimization, a company is effectively multiplying the output of their existing engineering team.
So they aren't necessarily firing people, they're just getting, like, 10 times the output from the same 50 developers.
Exactly that. They ship better features faster, the user experience improves, subscribers open their wallets, and the company's revenue goes up. All without a proportional increase in their payroll costs.
Yep, their revenue per employee just skyrockets.
Okay, here's where it gets really interesting, though. Because the AI boom isn't just happening in software. On the hardware side, AMD is one of the most active stocks today.
Yeah, their recent moves are huge.
Right. Our briefing notes they just acquired a chip startup that literally hardwires AI models directly into its silicon. If you think about it, moving from AI software to hardwired AI silicon, it's like moving from having a battery-saving app downloaded on your phone to just changing the chemical makeup of the battery itself to be twice as efficient.
That's a really great analogy.
It stops being a digital tool and becomes fundamental physical infrastructure.
And what's fascinating here is how that physical transition solves the biggest problem with AI right now, which is processing power and latency.
Because it takes so much energy, right?
Huge amounts. Currently, when you use a heavy AI tool, your device sends a request to a massive server farm in a desert somewhere. The server runs the calculation and sends the answer back.
Right, which takes time.
And massive amounts of electricity. But AMD's acquisition aims for something called edge computing.
Edge computing, okay.
Yeah. By hardwiring the AI architecture directly into the silicon of the device itself, which is the edge of the network, you eliminate the need to communicate with the cloud entirely.
But wait, if you hardwire an AI model into a physical computer chip, what happens when, like, OpenAI or Google releases a brand new, smarter model next month? Doesn't your hardwired chip instantly become a paperweight?
You'd think so, but that is the exact engineering challenge the startup is trying to solve. They aren't hardwiring the specific software weights or the knowledge of the AI.
Okay.
They are hardwiring the mathematical architecture. The specific neural network pathways that all these models use to calculate data.
Oh, I see.
By building the highways directly into the silicon, any new car or software model, in this case, can drive on them much faster and with a fraction of the electricity. It changes the entire economic model of how computation is sold.
Which perfectly explains why the sector trends in our briefing are heavily skewed toward infrastructural players today.
Absolutely.
Companies like Palantir and Astera Labs are seeing massive benefits. And zooming out to the broader tech index, the Invesco QQQ ETF, which tracks the NASDAQ 100, has delivered over 10% annual returns since its inception.
That is just a staggering historical performance.
It really is, and it's driven entirely by these compounding waves of innovation.
It's an incredible run for the digital layer of the economy,
Yeah.
but we really have to pivot here because the moment you step outside of that digital cloud, the reality is entirely different.
Right, into the physical consumer-facing world.
Yeah, the margin for error on Main Street has completely vanished.
Okay, so let's look at the winners and losers in the physical economy today, because the whiplash is intense.
It really is.
On the winning side, Ford is highly active and a top gainer. They just announced the Fathom, which is a brand new electric pickup truck, and it starts at an incredibly accessible $28,000.
Right, and that price point is what we call expanding the total addressable market, or TAM.
Because EV trucks are usually way more expensive.
Exactly. For years, the barrier to entry for electric vehicles, especially trucks, has been the premium price tag.
Right, like $60,000, $70,000 easily.
Ford isn't just releasing a new vehicle, they're actively making EVs a viable financial option for a massive demographic of blue-collar workers and families that were completely priced out before.
Got it. So in a stabilized economy where those 83,000 jobs are holding steady, pricing a product aggressively to capture massive new market share is exactly what investors want to see.
Precisely. They are expanding the pie.
Okay, so Ford is winning by basically handing out a massive discount to expand their market. But let's look at a company that is getting absolutely crushed today.
UWM.
Yes, United Wholesale Mortgage, or UWM. They are a massive loser today, plunging an unbelievable 35% in a single trading session.
It's a huge drop.
And that's after suspending their dividend and trying to raise capital. But wait, if that macroeconomic floor is as stable as you said, how does a giant mortgage lender just fall off a cliff like that?
It all comes down to how holding costs operate in a highly volatile interest rate environment.
Okay, let me see if I have this right. A holding cost is basically a financial hot potato. All right?
That's a good way to put it, yeah.
So UWM originates the mortgage for a home buyer, but UWM doesn't actually want to keep that loan on their books for 30 years, They hold it just long enough to bundle it with thousands of other mortgages and sell it to a major institutional investor.
Correct.
But if the market freezes because of rate uncertainty, they're left holding $1 billion of hot potatoes.
That is the exact mechanism. And every single day they hold that hot potato, UWM has to pay interest on the short-term money they borrowed to fund the mortgage in the first place.
Oh, wow. So it's bleeding them dry daily.
Exactly. So when they announce they're suspending their dividend, the cash payout they give to shareholders, and simultaneously trying to raise new capital, it's a glaring red flashing light to the market.
It signals they're desperate for cash to cover those holding costs.
You got it. It's an operational nightmare for them right now.
And they aren't the only ones facing visceral operational threats today either. Sweetgreen is another top loser.
Yeah, their stock took a major hit.
They had to cut their full-year outlook, and the briefing specifically cites cyclospora fears, directly weighing on their sales. Just quickly clarify for you listening, cyclospora is a microscopic parasite that causes severe foodborne illness, usually linked to fresh produce.
It's not something you want anywhere near a salad chain.
Definitely not.
Yeah.
But I want to push back here. If Sweetgreen finds out their lettuce supplier has a contamination issue, why can't they just, I don't know, buy lettuce from someone else the next morning? Why does this crater their stock?
Well, because a restaurant supply chain on a national scale, it's not like walking into a grocery store and picking a different brand off the shelf.
Right.
These are rigid, heavily audited contracts locked in months in advance to guarantee price and volume.
So they can't just switch on a dime.
Exactly. If a supplier is compromised by cyclospora, Sweetgreen can't just pivot overnight. They often have to pull the affected items off the menu entirely across hundreds of locations.
Wow.
When you combine the immediate loss of inventory with the devastating blow to consumer trust, where foot traffic drops to zero because people are terrified of their salads, the revenue shock is instant and severe.
So what does this all mean for the consumer? We have this unified macro economy adding 83,000 jobs, but on the ground, one operational misstep with a mortgage balance sheet or a batch of lettuce can erase a third of a company's value in hours.
It means the market is brutally efficient right now at punishing operational weakness while rewarding companies like Ford that successfully navigate physical constraints.
Right.
And that actually brings us to the most difficult physical constraint of all, which is raw materials. Ford's ability to build that $28,000 Fathom truck doesn't happen by magic. It requires massive amounts of commodities and energy, and the global commodities market is flashing severe warning signs today.
Yeah, the briefing notes. Extremely tight conditions in the refining market right now, which is largely driven by the ongoing wars in Ukraine and Iran.
Exactly. When you have major geopolitical conflict involving energy-producing regions, refining capacity, the actual facilities that turn crude oil into usable gasoline and diesel get squeezed.
Which hits the consumer directly.
Right. That friction keeps gas prices artificially elevated for the end consumer. It acts exactly like a tax, pulling disposable income out of the pockets of the very people Ford is hoping will buy their new truck.
But then we look at the other massive commodity story today, copper. As I mentioned at the top of the show, copper has jumped to its highest level ever.
It's a huge surge.
It's one of the top gainers across the entire market today. But the sources note, this is giving complicated signals about economic health. Now, people always use that worn-out cliche of calling it Dr. Copper, but I like to think of copper as like the flour in a bakery.
Oh, I like that.
You literally cannot make a cake, a croissant, or a baguette without it. And you cannot build a house, an EV battery, or a data center without copper wire.
That is a much better way to think about it. If you want to know how many cakes the global economy is baking, you look at the price of flour.
Right. So usually if the price of copper is at an all-time high, you would assume it means demand is through the roof. Everyone is baking cakes, which means a booming, rapidly expanding global economy.
Usually, yes.
But if the consumer is being squeezed by gas prices from 2 wars and mortgage companies are taking 35% haircuts, is this high copper price actually a sign of economic health? Or is it just a symptom of a global supply chain fever?
If we connect this to the bigger picture, it is absolutely a fever. We have to separate demand-driven price increases from supply-driven price increases.
What's the difference in this context?
Well, if copper is expensive simply because everyone is building houses and data centers, that's a healthy demand-driven market. But when you introduce profound geopolitical friction, you are disrupting the complex global supply chains required to mine, refine, and transport these raw materials.
Right, so it's harder to actually get the copper.
Exactly. It inflates the cost of goods regardless of consumer demand. This creates a very dangerous tightrope. You end up with rising costs across the board, which eventually stalls economic growth.
Which brings a really interesting element from our briefing into focus. We have SpaceX listed as one of the most active stocks today.
Yes.
The notes say they passed a key test, and sophisticated traders are betting that, quote, the bottom may be in. Now, SpaceX isn't just an aerospace company. They represent the absolute extreme of heavy physical engineering and massive capital expenditure.
Oh, without a doubt.
So if traders are looking at a successful SpaceX test and declaring the bottom is in for the heavy industry tech market, it implies that the market is finally ready to start heavily funding these massive physical infrastructure projects again.
Which perfectly illustrates the tension we're seeing today. Investors are looking at Grindr and AMD and realizing that the digital AI revolution is real and it's profitable.
Very profitable.
But they are also looking at SpaceX and realizing that this digital future requires staggering amounts of real-world physical infrastructure.
Right. You need rockets, you need massive new data centers, and you need next-generation power grids.
Exactly. And all of that physical infrastructure requires the very commodities like copper that are currently choked by geopolitical friction.
And all of these conflicting pressures, right? The tech investments, the consumer spending shifts, the commodity prices,
Yeah.
they ultimately land on the desk of one institution,
The Federal Reserve.
the Federal Reserve. Their job is to look at the 83,000 jobs, look at the record price of copper, and set interest rates to keep the whole machine from either overheating into inflation or stalling out into a recession.
Which brings us to the most sensitive piece of data in our briefing today. Right now, the relationship between the Federal Reserve and the political sphere is under intense scrutiny.
Yes. The notes detail that President Trump's relationship with Fed Chairman Kevin Warsh has raised serious concerns about economic risks.
That's right.
Specifically, there are reported phone calls between the president and the Fed chairman. The concern highlighted in the sources is that these interactions may complicate Chairman Warsh's efforts to prove the Federal Reserve's independence regarding inflation and interest rates.
It's a very delicate situation.
It is. Now, I want to make sure we're setting aside the political theater entirely, because we really only care about market mechanics on this deep dive. From a purely financial perspective, why is the perception of central bank independence so vital to the markets we've been talking about today? I mean, the math is still the math. If inflation is high due to copper and oil, the Fed has to raise rates regardless of who is calling them on the phone, right?
You would hope so, but markets price in human behavior, not just current math. This raises an important question about historical precedent.
Okay.
If you look at central banks that lack independence, take Turkey over the last few years, or several historical examples in South America, when politicians can dictate interest rates, they almost always demand lower rates.
Because low rates make borrowing cheap.
Exactly. Which creates an artificial economic boom right before an election.
But the hangover from that artificial boom is always massive inflation, right?
Precisely. And markets know this. So if global traders and investors start to suspect that a central bank is being influenced by political election cycles rather than raw economic data, they instantly change how they calculate risk.
How does that look in practice?
Let's look at buying a 10-year U.S. Treasury bond. You are locking your money away for a decade. If you trust that an independent Fed will ruthlessly crush inflation if it flares up, you feel safe accepting a lower yield on that bond.
Right.
But if you suspect the Fed might be politically pressured to keep rates artificially low, you expect future inflation to run much hotter.
Because inflation eats away at the value of the money you're getting paid back.
Yeah.
So to protect yourself, you demand a higher yield up front to compensate for that political risk.
Exactly. And here is the kicker. Higher yields on government debt ripple through the entire economy. It instantly makes borrowing more expensive for Ford to build their new Fathom factories.
Oh, wow.
It makes mortgages even more expensive for UWM to originate. It makes it harder for that AMD chip startup to get capital.
It's all connected.
Yeah. The mere perception that the central bank might not be independent fundamentally increases the cost of doing business across the entire stock market. Independence is the bedrock of market confidence.
It is the ultimate domino effect.
Yeah.
So for you listening, whether you're passively tracking the QQQ ETF in your retirement account, or whether you're waiting to buy that $28,000 Ford Fathom, or maybe you're just feeling the pinch of elevated prices at the gas pump, none of these stories exist in a vacuum.
Not at all. They are all deeply interconnected threads of the exact same macroeconomic fabric.
The massive leaps in AI software efficiency happening at Grindr are running perfectly parallel to the hardware innovations at AMD. But both of those digital dreams are crashing into intense physical world constraints in copper supplies and refining capacity,
Right.
all while the Federal Reserve tries to navigate the intense gravity of both global supply chains and domestic politics.
It leaves us with a critical question to consider as we look at the data today.
What's that?
We saw that AMD is hardwiring AI into silicon to make it foundational infrastructure. At the exact same time, copper, the absolute fundamental building block of all electrical infrastructure, has hit its highest price in human history.
Yeah.
If our digital future requires massive, unprecedented amounts of new physical infrastructure to run these models, will the ultimate bottleneck for the AI revolution be limitations in software code or simply the fact that the Earth might run out of cheap copper?
That is a fascinating thought to chew on. The physical limits of a purely digital world. Thank you so much for taking this deep dive with us today into the market's underlying currents. We love unpacking these briefings to find the structural mechanics hidden in the daily noise, and we are so glad you joined us to figure it all out. That's all for today's deep dive of Tech Money Madness. We'll see you tomorrow for more market coverage.